Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Um, if you're someone who thrives in fast-paced environments and loves making quick decisions, then this video is for you, okay? Because in this video, we are going to be breaking down the day trade, we're going to be breaking down the day trading scalping system. Okay, so if you are a fan of day trading, then this video is definitely for you. If you are a fan of scalping, this video is definitely for you. Basically, if you like, short-term trading, this video is for you. Okay, all right. Now, this is an effective strategy for short-term trading, and you can start applying it right away. So stick around as we cover everything that you need to know to get started. Now, let us start by defining what scalping is. All right, scalping is a trading style that focuses on capturing small price movements within short time frames. So, if you are a scalper, most of the times you're going to be focusing on the 1 minute chart, 5 minute chart, 15-minute charts. You don't really have much of business with the daily charts or weekly charts or monthly charts, because as a scalper, your point of focus are short-term volatility, the movements of price within shorter time frames. You're trying to capture quick price movements, right? So that is the reason why the focus is going to be mostly on the 1 minute, 5 minutes, and 15 minutes charts. Although in some cases, you can have some traders perhaps scalping on the 30 minutes or the 1 hour, but in such cases, you are now tending towards day trading, right? So it's no longer exactly scalping per se, it's now getting towards day trading. So whatever the case may be it scalping on the 1 minute or 5 minutes or 15 minutes chart or day trading, this system, all right, this system works efficiently, right? It works effectively. Now, let us just discuss quickly the three principles for the day trading scalping system. Okay, we're just going to discuss the key principles. The first is time frames. Okay, it is very important to know your time frames when you are scalping. All right, so like I said, scalping works best on shorter time frames, such as 1 minute, 5 minutes, or 15 minutes charts. Okay, when you start going towards 30 minutes or 1 hour, that means you are probably now day trading, right? Because your trades will likely last for a couple of hours, and in some cases you might even have your trade run for a whole day, right? So that is no longer scalping, right? All right. Now, these time frames, that is the 1 minute, 5 minutes, and 15 minutes, they allow you to spot micro trends and capitalize on them. Okay, now secondly, we're going to be talking about indicators. Okay, the indicators are also important components of this trading system, and this system relies heavily on technical indicators to identify trade opportunities. So we're going to be using moving averages, to track trends, and oscillators like the RSI or stochastic. So I'm even going to be adding the moving average to the chart right away. I'm just going to add a 50 EMA for now. And then I'm also going to add the relative strength index to the chart. Okay, we can use the RSI to find overbought and oversold conditions. And then we can use the moving average to quickly spot trends. Okay, and then finally, volatility and liquidity is another important factor to consider when using this system. Okay, scalping thrives in highly volatile markets with plenty of liquidity, right? So pairs like the Euro USD, you can see that I'm currently on the Euro USD chart. Okay, this is the Euro USD chart, and pairs like this, or GBP USD, such volatile and liquid pairs, they during active sessions, they are great choices for this strategy, right? Euro USD, that is the euro against the US dollar, the Great British pound against the US dollar. These are great pairs, right, for this strategy, especially during active trading sessions. Now, let us set up the system step by step. Okay, now the first is to apply a couple of indicators to the chart. Okay, now we have already applied the 50 period moving average, specifically the 50 EMA, right? You can see period set to 50, exponential moving average method. This is the 50 EMA. Okay, so we are also going to be adding the 20 EMA to the chart. Now the 50 EMA, mind you, the 50 EMA is used for confirmation of the overall trend. Okay, so the 50 EMA is for confirmation of the overall trend, while the 20 EMA is used to identify the short-term trend. Okay, so you got to take note of that. Now the relative strength index is the third indicator. We have two indicators, right? The relative strength index is used to gauge momentum and identify overbought and oversold zones, and we're going to be using the default settings, which is period set to 14. Okay, now how does this work? When the 20 EMA, right, when the 20 EMA is above the 50 EMA, it signals an uptrend. Okay, and you look for buying opportunities. So you should be looking for buy opportunities when you have this bullish crossover. All right, and then on the other hand, when you have the 20 EMA drop below the 50 EMA, it indicates a sell trend, it indicates a downtrend, and you'll focus on selling opportunities. Now for entries, you wait for the price to pull back toward the 20 EMA, and then you confirm with the RSI. So for example, if the RSI dips below 30, right, let's just look for a good example. Okay, if the RSI dips below 30 in an uptrend, now in this case this was not an uptrend, so let's just see if we can find such example in an uptrend. Okay, now it doesn't necessarily mean that the RSI must always dip to the 30. Okay, whenever you have an ongoing trend, for example, let's just use a very quick example, you would mostly find out that the RSI will be trending upwards, so there's no how it can remain below the 30. So as the price is making higher highs and higher lows, the RSI will most likely be making higher highs and higher lows as well. So long as your RSI is following the trend and is maintaining its position above the 30 level, and after the trend has gone for a while above the 50 level, then you are good to go. Okay, but when the trend is about to start, then if you find RSI below the 30 level, for example around here, when you find RSI below the 30 level and you have a cross to the upside above the 30 level, then it can show that a bullish momentum is about to set in, right? So you can start looking for buy opportunities right from that time. Okay, but basically if the trend has already begun, then just watch out for the RSI maintaining its position above the 30 level, and then always making higher lows, most especially that's for the RSI, right? And then in the case of a sell, when the 20 EMA is below the 50 EMA, it indicates a downtrend, and then you focus on selling opportunities. Okay, so in a downtrend, when the RSI crosses above the 70 and then drops, for example here, right, it's a potential sell signal. Okay, so we can see that we had a sell setup around here, right? You can see this was when the trend was about to start, so we had RSI above the 70. So and if eventually you can see that the price continued to make lower highs and lower lows, and you can see that the RSI did not get above the 70 again until when the sell trend was coming to an end. So that is the reason why I said once the trend is about to start, it's great if you find the RSI in the overbought territory that is for sell, or in the oversold territory for buy. But after the trend has already begun, just watch out for the RSI maintaining its level below those oversold or overbought zones. All right, and make sure that RSI is giving signals of momentum in the direction of the trend. For example, you can see here the price was moving sideways, so RSI also moved sideways for a bit, and then it was around here that we can see a notable sell structure on the RSI. You can see, and that was corresponding with this decline. And then here we had a pullback, and the RSI also pulled back upwards, and we had another decline, we had another sell structure on the RSI. So basically that is how it is. Okay, now a few quick tips to make this system more effective is: one, you have to stick to volatile pairs. All right, an example is the Euro USD. Okay, or you can use USD JPY, or any of such major pairs, right, during active trading hours, because this ensures enough movement for scalping. Secondly, you have to limit your trades to high probability setups that align with the system. Okay, over trading can hurt your results. And then finally, risk management is key. Only risk a small percentage of your account per trade to protect yourself from unexpected losses. Okay, remember, scalping is not about predicting huge market moves. It is about being consistent and disciplined, right? Taking small, quick trades that add up over time. Okay, so that is scalping, right? Now let's just quickly recap the day trading scalping system. Remember, you have to use the 20 and the 50 EMA to identify trends, and then you confirm your entries with RSI for overbought or oversold conditions. Then you have to focus on volatile pairs during active sessions, and always use stop losses and stick to your risk management plan. Okay, so if you enjoyed this breakdown and learned something new today, don't forget to smash that like button. It helps the video to reach more traders like you. And if you want to dive deeper into effective trading strategies, make sure to hit that subscribe button and turn on the notification bell so you never miss a new upload. Thank you for tuning in, and as always, happy trading. I will see you in the next video.